Eileen's question was essentially, I have two long calls that have gotten away from me. And is there anything that can be done? A 15th of September expiration 275 call on Tesla. So we're only 21 days to expiration. The stock's at 238.59. Price was 1601 for when the call was bought. I don't have the actual date, but it was 1601. And the value is now 136. So we're down about $1,400, $1,465 per contract. The other one is a call on Microsoft, the 395 call, which is out to October. Little bit more time. Paid $7.86. It's only worth 38 cents. We're down 95.2% on the Microsoft call and 91.5% on the Tesla call. Now, again, some of those videos I referenced in the playlist, managing a long call that is near full loss. Some ideas might exist there that might help you. We'll try to take a look here. As I mentioned, I didn't have a chance to look at this ahead of time. Let's start with Tesla first. We're at a 91.5% loss with a shorter time frame, 21 days to go. I'm going to go to the profit and loss chart. We know what this looks like. We paid $16.01 for a call that's down to a low price here. We're losing 91.5% on it. When we normally discuss these presentations, we have to discuss first things. I don't want to say the obvious, but the generic approach and the general idea. Number one, in any strategy where you could lose potentially 100% of what you invested into the trade, that could be any strategy really, but the more likely strategies are the leverage strategies. Why you're trading them is to get more bang for your buck. I'm going to buy calls instead of buy the stock on Tesla. I'm going to buy puts instead of shorting the stock to make profit with leverage. I'm going to use a credit spread. I'm going to use a debit spread. All those positions, you can lose 100% of what you invested in the trade. And here we're pretty close to it, a 95.2% loss and 91.5% loss. With any position that you can potentially lose 100%, no one wants to take a loss, but your best bet is to control the losses to a reasonable range. In other words, set an alert in the portfolio. For long calls, whenever I do a poll, when we're doing a long call discussion, the common stop of the attendees that are in that answer the poll are using a stop of somewhere between 30 to 50%. I think most common is 35 to 45%, but about 30 to 50% of what you paid into the position. So even if you're hoping against hope that this would recover, you say, oh, it's just the market conditions it down. But when you got to a value of, $8 or $9 on this position, you should have considered managing at that point, closing the position, taking the loss, and moving on. We don't necessarily have to keep trading the same stock to fix it. Sometimes it's okay to just close the position. We took about a 1465 loss on this. Let's look to make that back in another stock, in another security that is doing what we want for this strategy. We wanted to win on Tesla. It's all in the news. We thought, hey, it's going to come up. Oh, it's been on a long run. Let me jump in now. And then you had the wrong timing. Well, instead of just converting to a put because you think it's going to go down and getting hurt both ways, if you can't pick the direction of the stock, kind of doesn't matter which call you're going to purchase. If you're on the wrong side, you're going to lose on all of them. Okay? You're going to lose on all call options. That's just part of the problem that you run into. Okay? It could be bad timing, could be bad market timing, could be something that just occurred. But any position that you can lose 100% on, you should try to control the loss to 30 to 50%. Okay, as a trigger. Number two, any criteria that you use initially to get into the position. I got into a long call on Tesla because I saw a MACD breakout. I saw a Bollinger Band breakout. I saw a Fibonacci that I wanted. The stochastics matching my criteria of what I think would be a bullish stock over the next 30 to 60 days. If any criteria, technical criteria for the stock that you use to get into the position now reverse to where we see a negative MACD, the stock drops below the 20-day moving average, opposite of what we want for a long call, or 50-day moving average. Anything along those lines, that might be your second trigger to consider just getting out of the position or use management then, not to when the stock is down so low, we've waited so long, 21 days remaining to expiration, and we're at a 91.5% loss, okay? I don't mean to sound like Captain Hindsight, but in Eileen's email, she said, maybe I should just stop buying out of the money calls. Well, we're going to take a look at that too. Okay, we're going to take a consideration into that as well with tool and power options, but we need to cover this first. And whether you're buying out of the money calls, whether you're buying in the money calls, whether you're buying at the money calls, just buying the call and hoping that you pick the winning stock is not necessarily a successful approach. You're going to have your triggers set to manage the positions so you no longer get into this situation. When Tesla, was up at 280, I might have bought a 240 call that was deep in the money that had a high delta. And at this point, I still might be at a 75% loss. Not 90%, but I still might be at a significant loss in this position, depending on what I paid for it initially with the intrinsic value. Again, that's a concern. You can still lose no matter which strike you pick. And of course, the third thing I want to reiterate, and I think these are small positions, so Eileen's correct in that. Any position that you can lose 100% on, the leverage trades that I mentioned, credit spreads, debit spreads, even calendar spreads in a sense, you're not going to lose 100% on a covered call unless the stock goes to zero, or cash secured naked put. Definitely not going to lose 100% on a married put. You can lose 100% of the maximum risk, which would only be 5, 6, or 7%, or in a standard collar. True. But that's only going to be 5, 6, or 7% total of the position and the investment amount. Protection properly in place. Okay? All right. So 3 is proper position sizing, meaning that anything that can lose 100%, these leverage positions, should probably not represent more than 10 to 20% of your total portfolio value, because they can and they will drop 50%, 60%, 70%. Mark's got a question coming up on bull put credit spreads. Many of you know that that's one of my most favorite strategies when the market conditions are correct. However, even with the approach that I set up and that worked well for me for many, many years and still works well for me in the right market conditions to hit my targets for what I want, there's still once or twice every 18 to 20 months where that portion of my portfolio is down 50% just because from some unforeseen event, black swan event, that causes the market to pull back. When everything else was bullish, it wasn't the stock's fault. They're still leaders in their industry, but the market just had a bad few days, comments from Powell, things of that nature. And even though you're in a bullish run, an extended bullish run in the market, all of a sudden there's a correction of a 3 to 5 day period. The 3 or 4 bull puts you have are down 50% of their maximum loss. It's better at that time to close, not to manage necessarily in those situations. And yeah, your portfolio will drop 50%. But if that only represented 15% of my total portfolio, I'm only down 7.5%. I can make that back up. So to be successful, whether you're doing out of the money calls or buying puts, whether you're at the money with the highest time value at the time, but you're hoping for a good 7, 8, 10% movement, which would probably be the highest profit. We'll showcase that in a moment. Or whether you're trading in the money covered calls as a stock replacement with a high delta, you want to have a stop losses set related to what you're willing to lose on the position, not let something to go up to a 60, 70, 75% loss. Don't hold and hope that it's going to come back. Could it? Yes. But long term, you need more of a trading strategy and a trading plan as opposed to, hey, Tesla's going to go up. I think it's going to go up to 350. I want to make a killing. Let me buy this out of the money 275 call when the stock's at 250. And then here we are. Any trigger that you use to get in, technical or fundamental on the stock, if that reverses while you're in the trade, it's going the opposite direction. The out of the money, the at the money, the in the money long call position will not be profitable if it's going the wrong way. Even if it's stagnating, you're just going to see time value decay as you get closer to expiration, and it's not going to be profitable. Need the movement, need the indicators, and if those go negative, those turn bearish, you might want to consider adding protection, adjusting the position, or so forth. Proper position sizing. Don't overtrade the positions even though they're leveraged. That's the general rules. Now, what can we do with these positions now? I'm going to walk through the base, obvious things first. We're going to list them first, then we're going to look at some of them in action. Number 1, close out. Take the loss, move on. We are wrong on these positions. We don't have a clear direction of these two stocks, Tesla or Microsoft. I'm not going to give any insight into direction. We can't do that legally. And I'm not going to make any projection of where these stocks are going to be in the next 20 to 30 or 40 days. Close, take the loss, move on, look for other stocks that do match the goals of the long call strategy. Things that are trending up. Well, I mean, we're seeing a good move today at 855, but 21 days to get up there just to break even, and your break even, as we can see, is 291.01. Could Tesla do that in 21 days? Of course. Is it worth hoping and holding? I'll talk about that in a moment. Usually it's not. Number 2, do nothing. That leads me to number 2. Close the position and take the loss. Number 2, do nothing. Wait, see if it recovers. No one wants to take a loss. No one wants more of a loss. Why do I even mention this? You're already at a 92% loss roughly on this position. All you can lose more is an extra $2, right? It was around you lost a $14.65. So you can just lose another $1.35 on this per contract. The other one, the Microsoft one, is down 95%. You're near full loss on the trades. 21 days here. What was it? 56 days here. Can't lose much more on these trades. Maybe it's okay to hold on, see if you can get for less of a loss on the position. Maybe get to break even. Would never promise that, would never expect that, but who knows? Okay. Close, do nothing. Number 3. Common approach to these situations is simply roll down. We have a loss. We can roll down the position, meaning in this case in Tesla, we could sell to close our 275, take that loss, and then buy something maybe that's out to December or January. Give ourselves more time on a position we think would recover, not the loss on the initial trade, plus a little bit of extra profit to get back to break even. So roll down and out. Obviously, the pros and cons here are you're giving yourself more time for the stock to recover, to try to get to less of a loss or a break even. The main con here, of course, is now you've got more money into the position. You've already lost $14.65. You pay another $18, $19 for another call that's that far out in time, or another just 90 to 120 days out in time. You could lose this $14.65 here, plus the next 18 you pay, be down $3,200 per contract instead of $14.65. So that's definitely a pro and con of this position. Number 4, convert it to a calendar, meaning we could try to sell weekly calls against our long call for the next remaining 21 days. So it'd give us about 3 right cycles to try to cut into this loss, make back the $14. And maybe the stock continues to move up and we can get ourselves a little break even. It's not going to be a one and done repair, Eileen. You're going to have to do it multiple cycles. We might be better off with the Microsoft one converting to the calendar spread. It caps the gain, though, and you might lock yourself into a loss. However, it might be less than a loss than that loss of 14.65 or 91.2% we're seeing right now. So convert to a calendar call spread with a plan to write multiple times against it in order to knock down the cost basis. Number 5, and this is not any particular order of best to nothing. It's just what comes up in my mind when I'm doing it. Close and do the opposite. We've been wrong on the direction, although it started to pull back up in price. It started to move back up in price and has been bouncing around always, of course, because it's Tesla. Close and do the opposite. We were wrong on this direction. So let's close the call and take the loss. And similar to what we do here, maybe we buy a put. That's out to December or January, at the money, maybe slightly in the money, hoping that if Tesla continues to slide and starts to slide back down maybe to 220, 210, or 200, we'll profit on the put, which will counterbalance the weight and the loss on the initial position. Number 6. Some people try this. I don't like to do it. I'd rather close this and get the $1.35 back and then do the opposite and buy a put. Some might say just buy a put. In other words, take your long call position that you're not sure where it's going right now, or combine it with 3, roll and buy a put and a call, so you create an out of the money long strangle position or a straddle position. The problem here is you are realizing the loss You're not realizing loss, but you could still see the loss here if you close it and roll it out and then do into a strangle because you don't know the actual direction. You just expect volatility. Well, we're paying into a lot of volatility here. We're paying into 2 volatilities now. But then you're going to be saying, okay, when I get a profit range on the put, I'm going to close it, maybe take the profit and adjust it, and then maybe adjust the call again or consistently move the strangle with the stock back and forth, trying to profit a little bit here, a little bit there, in order to eventually cut down this 1465 loss plus the extra cost of the put. And I'm just going to stay with number 7 here. I don't think I have an 8th one, but number 7 is we talk about the stock repair tool. And we may have to take a look at that after we walk through some of these examples. The stock repair tool helps us build a ratio call spread against a position that's losing. Okay? And it can help you get back to break even faster. It doesn't work the same way with a long call, but it might be able to give you some ideas. Effectively, what you're doing is creating a condor or a butterfly on the position. In this case, it would be an all-call butterfly or all-call condor to try to repair the position and have a subtle range of profitability down near where the stock is. Okay? Now, I know that wasn't a good example of drawing it, but we're going to show that more. So remember, take the loss, do nothing, hold and hope, because you're already at 90-95% loss in these positions. Roll down, which comes with, all of these come with pros and cons. I just illustrated those as number 3. Convert to the calendar spread, which you'd have to do consistently. You'd be looking to sell short term and continue to move and move and move to try to make back the loss that you might take or get back to break even. 5, close and do the opposite. 6, buy a put to create the strangle, which with this time frame is hard. You'd have to roll it on time. And number 7 is similar to that stock repair. Okay, so we're wrong on the position of the stock. It's been dwindling around here. It's been bouncing around. Let's just take a look. It moved up another 8 points today, so it's a good percentage movement today. It's about 3%. But you had this slide that was just sliding and sliding and sliding. Somewhere in here for the Tesla position, if you were already in it here, I may have looked to close the position. If I'm thinking, of course, if I got in up here when I was seeing sort of the movement I want, but I didn't have a positive MACD on this position. That's not everyone's tactic, but that's what I like to see. But we've been sliding and sliding. And we did hit a bounce here. So this might have been a good time, if I closed and did the opposite here, it might have been able to say, oh, look, it's starting to rebound and move back up. I'm starting to see this crossover or close to it. Maybe now I sell to close that put and I buy a call here because it's starting to show me a little bit of strength after this decline. Not a lot. It's just sort of leveling out here in this 240 to 230 range. In any case, not additional insight or any grand insight to what's going to have the future is going to hold. Oh, I'm sorry, folks. Simply rolling down, what am I going to look to do? We're going to take a loss on this position, as we talked about, of about 1465. We're going to get about 135 back. So we're going to have a loss about 1465. I sell to close this position here. I'm going to simulate it by just clearing it out. And then, as I said, I probably want to give myself another 90 days or so, maybe 120 days out in time. And that's a good value. It might go to December. And the stock's at 238, so maybe I go down to 240. Or maybe I go to 230. I'm going to talk about that in just a moment. Let's go ahead and go with sort of the at-the-money 230 at 32.45. A lot of time value in there. It's 112 days out. Let's clear this out. And we know here, buying this position, we know our initial position, I should say, we had a break-even of 291.01. This one's much lower at 262.65. As a static position, what I also have to calculate in here is the 1465 loss that I realized by selling to close the call initially and buying to open the new call here at 230. So the 1465 here is going to put us at about 47.30 if my math is correct. We're going to have a cost basis of 47.30. The static break-even at expiration is 277.30, and we've given ourselves 112 days, about 90 more days out in time to hopefully see some kind of profit on this position to counter the loss. Big con, Instead of having 1601 invested per contract, I now have 4730 invested per contract. Much more to lose. Really want to make sure I'd set those boundaries with myself. That 50% stop loss, watching the technicals and fundamentals for getting into the position. Is this even a reasonable price? A strike, excuse me. The time frame's good to give ourselves more time. We're not going too far out and paying too much. We're not paying $80, $90, $100 for a 2025 call, for example. But does this call even make sense by itself, let alone to the 277 range I need to get to break even at expiration, hopefully probably only 250 or 260 to get back to break even sometime in the next 30 to 40 to 50 days. Well, this is where another tool we have on Power Options comes into play, and that's the long option finder. And what this tool does, we can access this either through the signature tools, on the main view, signature tools tab there, we go to long option finder. We can just put our stock in here up at the symbol lookup field and click on, I'm sorry, it's not there. I'm sorry. Strike that. I'm ahead of myself. My apologies. I'm going to stock repair. We're going to do that in a moment. Under long call or long put, we go to the long option finder, or under the signature tools tab, we go to the long option finder. All right, so Tesla's at 238. If I expected just a 10% movement in the next 40 to 60 days, it'd just be $23. All right, so that would put us we're at 238, let's call it 240 now. That would put us at about 263.80, 264. Let's just call it 264. And well, I know I have an investment amount if I roll, but right now I have an investment amount of 1601. I'm going to double that to 3200. And my expected date, let's put it right in mid-October somewhere, right around that 45 days or so out in time. And this takes a little bit of time. But what this long option finder tool is doing right now is it's going out across all expiration dates for Tesla, grabbing the current price of the option and using the Black-Scholes theoretical pricing model to calculate what each option would be worth if the stock hit my expected target, about a 10% move sometime within the next 45 days. Now, I chose the 230, slightly in the money. What this tool is showing me is which one would give the biggest bang for the buck, the biggest return, or the biggest value on investment if the stock did hit my target price on or around my target date. And as it turns out, naturally, the shorter term ones with less time value would give the best return if this was my projection. So the cost is $31.65 for the October 220. Slightly more in the money. And you'd say, wouldn't those out of the money options give more return? No, it shows you here the expected value of these options using Black-Scholes theoretical pricing model, current implied volatility for all of the options. It's not etched in stone, but the October 220 would give the highest return of 39% of what you invested into the position, and not the highest monetary return, but percentage-wise based on what you paid. And look here, the total value of this position, the October 220 call, if the stock was at 264 on October 17th, would be 44.10. Not exactly to break even of the rollover that we simulated, rolling to the 230 call at 4,730, but a value here with a cost of 31.65 plus the loss of 14 would almost have you back to break even for your total trade on the position. So this isn't factoring in that initial loss, Eileen, but what it is doing is saying, hey, simple projection, 10% gain up to 264 in the next 45 days. Which option would give you the best theoretical return? And there you go. Why aren't you seeing the out of the money ones from October? The 240, the 250, the 260, which are cheaper, because they'd all be at zero. They'd have no value because they'd be out of the money right around October expiration. Is this a reasonable expectation? Well, absolutely. 220 call, October 20th expiration. Tesla's at 264 on October 17th. It'd be $44 of intrinsic value. That's probably spot on to what the price would be. Right? It's easy to do near expiration because it's intrinsic plus a little bit of time value, 1 or 2 days remaining, but it's still a 39% return. So not to complicate things more, Eileen, but this long option finder, you put in your projection. If I put in a projection at the opposite, that I thought the stock was going to go down to 212 in the next 45 days, that would take care of number 5 for us, close and do the opposite. We take the 1465 loss. We're projecting that Tesla might drop down to 215 or 212 in the next 45 days. Which put's going to give us the best bang for the buck? It's the slightly in the money, 250, 255, 260. We're not seeing the out of the money 200, 210, or 220 puts because they're not going to yield as much profit as the slightly in the money options were. This goes back to your concept that said I should stop trading out of the money covered calls. This is what this tool taught Ernie and I. If you expect a reasonable growth in a company, you're not looking to hit a home run every time, a reasonable growth of 3, 4, 5% per month, 10% over a 3-month period perhaps, this tool helped us identify which calls were the best ones to buy. And with those more subtle movements, realistic movements on bullish stocks with all the volatility that goes around, the slightly in the money and at the money calls with these types of movements would give you the best return. Now, of course, if you're shooting for the moon and you think Tesla is going to rocket up to $345 sometime in the next 45 days, yeah, you're going to see all of the out of the money calls with 1,000% returns you can shake a stick at. Okay? But again, that's an unrealistic potential expectation. Could Tesla do it? Sure. Could Microsoft do it? Possibly. But again, without that type of movement, you're not going to see these type of outpaced returns. Okay? It doesn't matter which strike you choose. Yeah, here we are, though. We're at the 310s now, 305s, 300s. You won't see those yielding a profit if your expectation, of course, is that you're just expecting a normal growth of 3 to 5% per month on a good bullish stock, or maybe 10% over 90 days or something along those lines. This tool will help you identify which call would give the best profit if you've made the decision to roll the call up using concept number 3, or roll the call out in time and down, I should say, or option number 3, or option number 5, close and do the opposite. Let's go back to your original position here on Tesla. Okay, there's that 1601. We know we're losing 1465. Converting now, we can't use August 25th. So we can only use 3 cycles, 1st, 8th, and 15th. Now, again, this has to be based on your projections of where you think the stock's going to go, because I don't want to necessarily get locked in a loss. But I can generate some premium against the position. I only have 3 right cycles, so it's going to be close. But let me give myself some breathing room here, and I'm going to sell the 245 call for next week. It's like a covered call, or what some call a poor man's covered call, but now it's reversed. I'm actually creating a bearish position because instead of buying an in-the-money call to mimic stock ownership, trying to manage an out-of-the-money call by selling a lower strike call. This is going to actually create a bearish position for the first few right cycles. There's no chance of profit in that first cycle, but if the stock does stay below 245, this call expires worthless and your cost basis is down to 1276. Then you could potentially sell the next call against it, maybe not even the strike, depending where the stock is, get another $3 or $4 and knock your cost basis down to 900. It's a defensive play. But the risk triples, not to the downside, to the upside, because whatever gain you might have gotten if the stock goes back to 260, 265, you've capped by selling this, just like you would in a covered call. You wouldn't see the extra profit to the upside. You would now have to watch this more carefully, roll this call if the stock goes up to 245. And as we know with Tesla, that can happen in the morning. We could wake up on Monday and the stock could be at 256 for whatever reason. It could be at 210 for whatever reason, whatever events happen over the weekend or anything like that. This might be a better one to do with Microsoft, which is more stable. Try to write it through October, selling out of the money calls to give you some room, but set yourself some really strict alerts on that one. Meaning that, hey, if I sold to 245 here, if Tesla gets to 240, even if it costs me more, I might need to buy this back and roll to a higher strike the next week out or 2 weeks out in time, right to this expiration to create a spread. Could you create a vertical spread and make up 1601 at this point? Not likely, but let's take a look. If we kept the same expiration for 21 days out, and I sell something that's out of the money, yeah, it's not going to work. I didn't think it would. Let's say I sell the 245 for the same expiration. What would this do? This would create a bear call credit spread, but it's a bear call credit spread at a debit, so you still have the potential to lose even if the stock's below 245, but you're only losing 846 now instead of 1465. But again, you're risking 3 times as much if the stock does go up above 275, because now we have to cover the 30-point loss in the bear call credit spread, plus that debit that we paid of $846 into what should be a credit spread. That's why I don't usually recommend it unless it's not too bad of a movement where it can be managed. So, the calendar spread slash regular position. Strangle example, we're not going to show. It's just going to be, too deep of a loss. What would I do with a strangle? Hey, you buy an out of the money put maybe at 220 or 230. Okay, I'll do it. I said it. I might as well do it. Same expiration, or you could close it, take the loss. Let's just buy a 220 put. Yeah. It's cheap, naturally, because, oh, shoot. Sorry, folks. I'll take care of that in a moment. So now you have a risk of $19.38 if the stock remains between $200.62 or $294.38. No man's land, dead man's valley, right? Death valley. That's what a strangle gives you. The probability of the stock being below 200 or being above 294 in the next 21 days is probably 5, 6, or 7%. Not likely to get back to break even. Now you've increased your chance of loss total from 1601 to 1938. Sometimes it can be managed this way if the loss isn't that good and you expect volatile positions and you have 60 to 90 days or more remaining in the trade. This close, the long strangle is really not worth it because the probability of the movement you need in 21 days with Tesla, anything's possible, but you understand what I'm saying. Last but not least, we mentioned the stock repair. Could a repair even be found for 21 days out? And how would I do that? I don't own stock. I own a call that gives me the right to buy shares of stock at $275, and I paid $16 for it. So my break even is $291. Let's try it. We're going to mimic the potential and see if anything's available in that September expiration. Why am I focusing on the September expiration? Because that's where your call is right now. Unless you roll it out and then do the stock repair. But what would you use as a price? You'd use the break even. Where do you need the stock to be to break even on this call in 21 days? 291. So we're going to put in a cost basis of 291, and I'm just going to simulate 100 shares if you own one call. Okay? Nothing, 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 nothing. 15th of December, there's a repair detail where you'd lower the break even down to 259.18. If you own the stock, not the long call. Okay? So no repair details. We could have used this as a guide. What it tried to do is build a repair by selling 2 December 260 calls and buying 1 235 and getting a net credit of 765. But in order to get the full benefit of that stock repair, you need to hold it to expiration. And you can't hold it to expiration because you have a long call right now that expires in September. Meaning that if I left this open, this ratio would be a naked call with a bull call debit spread, and it had infinite risk to the upside. But let's go back to our custom spread tool. Let's try to use those numbers for the 21st of expiration, 21st September. Oh, I'm on 15th of September, 21 days away. I apologize. Said that wrong. Could I use those same numbers? Could I buy a 235 call now? Probably not. All right. At 12:30. Oh, it's close though. But I could sell 2 245s. So I'm going to buy a 235. You have the 275. All right, it's going to look weird, but we're going to try it. We're at least going to get a credit on this side. What am I going to do? The ratio call repair, you're buying one at or slightly in the money call. I'm going to sell twice as many calls above it. So if I'm paying 12, let's just call it 12.55 here, keep the number simple, and I'm selling 2 at 7.55 to get 15.10, I'm going to get a net credit of $2 or so, which is going to cut down the cost basis to 13.48. No chance for a profit. Essentially what you did is created a butterfly position. You're trying to get to where this peak would be at max profit, factoring in the loss of this call. Here, this butterfly doesn't work. Doesn't mean that there aren't other strikes that might work with this butterfly. Buying a lower strike, slightly in the money, or maybe even out of the money, but selling 2 higher strike calls to get that, and then you might see a peak at break even, which is lower than what your initial break even is of 291. I'm going to try one example, Eileen, but we're not going to spend much more time on this in this case. But I'm going to try some of these out of the money ones that are closer. I really should try an even spread. But it's going to be kind of weak. But we are going to use the 240 in this case. And the 255. It's not quite equidistant, but it's a little bit closer. But there's no net credit. I can't do that. I have to go at least to the 570, it looks like, to get a net credit. And that's not even going to be that high of a net credit. So I don't think this one's going to work either. So again, the action here, I'm buying that lower strike call, just one. So now my 275 and my 240 are the outer wings of my butterfly. We're going to sell 2. No profit. Darn it. So again, in this case, when we don't, one of the suggestions we make on the stock repair is if you run the stock repair and you don't see a repair, what you might want to do is consider averaging down to get a better break even and then run the repair again. So what you might consider doing is rolling down and out that option number 3 we talked about, then evaluating the repair as well in this position. Okay, so that's the basic exercises that I wanted to walk through. That's the basic ideas. Some of them don't work. The calendar spread right now doesn't work for this one. We're not seeing a good stock repair, aka converting to a butterfly in this case to repair this position. Buying a strangle, too close of a time, not a good repair. You might be able to combine rolling it down and out and doing a repair to see if that works. I'm not going to go through every possible monetary example for you. You're going to have to do some of that work on your own. And with the Microsoft position too, you're going to have to evaluate some of those ideas on your own. And of course, I mentioned as a refresher, go to our playlist on the YouTube channel, go to call buying and long calls. You'll be able to see this discussion, but also managing a bought call that is near full loss. Can I use the stock repair for a bought call that is down? How to do that? At first, most important was ideas for managing a losing long call. You'll see some similar discussions, different examples here. Not your position exactly, because I can't give direct advice on positions. I can just walk through the motions, walk through the exercises, ideas that I would use to potentially try to manage these trades. But again, remember, option 1, option 2, option 4 are still on the table. Option 1, close and take the loss. No one wants to do that. These positions aren't doing what you want. You do have 56 days available for the October 395 on Microsoft, so you have more time. This 21 days is a little bit concerning. You're already at a 91.5% loss. You saw how the repairs didn't work that well because of the shortest of the time frame. Okay? That being said, number 1, close and take the loss. Number 2, do nothing. Hey, hold and hope. You're already at 95, 91% loss. You can only lose another 38 cents more here on this position. You can only lose another $1.36 or $136 per contract here. I don't know your contract size. Don't need to, because I can't give direct financial advice in that situation. Anyway, but again, you're near full loss. It got away from you. Maybe there's an opportunity here to do nothing, wait, see if the market turns around, see if these 2 stocks turn around to where you can maybe get out at less of a loss, or maybe better opportunity for some of those management techniques we discussed. Okay, close and do the opposite. Roll down the existing one to give yourself more time and a better break even. Close and do the opposite to buy a put if you think the market's going to be declining. Creating that strangle, that calendar spread idea we mentioned, and then trying to create sort of that broken wing butterfly butterfly position with a stock or pair to get back to break even. All that being said, number 8 is similar to 1. Close the position, take the loss, look to make it up with another security that is moving in a desired direction that seems strong enough that matches what we need for the long call approach. Remember, as I mentioned, without a management plan, without a trading plan, without a plan to make rolls and adjustments, if you buy a call at any strike price and any expiration potentially, and the stock does not do what you need it to do for the strategy, doesn't matter if you bought the out of the money, the in the money, or the at the money calls, you're going to lose money. You need the direction of the stock to match the sentiment that you're in. Would I have less of a monetary loss with an in the money one? Maybe. Depending on the movement of the security. In other words, I might still be down. I might have paid $32 for that long call instead of $16 that we did here, of course, right? But at the same time, I might only be down 40 or 50% to down to $16. So losing $1,600, $1,700 more than you're losing here with the out of the money call, but I might have paid 32 or 31, so I'm still down 50 or 60%. Okay? It does become a numbers game. And Wes said, boy, now I see why the married put trade and manage it the best you can. Okay? Oh, and manage it the best way you can to go on with your life without the outside loss, I think is what Wes was talking about. That's the advantage of the married put, is that even though I'm in these situations, instead of being down 91 or 95% of what I invested in the position, the structure of the trade and proper position sizing meant that I might still be down $1,400. That's only going to represent 5 or 6% of what I invested into the position rather than 91, 95% of what I invested into the trade. And with a 5 to 6% loss, that means I only need a 5.3 to 6.4% gain on my next trade to get back to break even. Whereas if I have a 95% loss, I need almost a 240, 250% gain on what I have remaining. No, I'm sorry, it's closer to 1,250% gain on what I have remaining just to get back to break even. All right, so again, Eileen, didn't find an answer for you and went through some of the motions, the same motions I would go through. But again, you're near the full loss in these positions. Nobody wants to take the loss. Best bet to start with might be to do nothing and see what happens over the next week or so. This one you really have to watch because that would put you, a third of the way closer to expiration, right? You'd only have 14 days left at the end of next week instead of 21. But you're already at near max loss in these positions. So we can do nothing, hold and hope. It's not the best approach, but it is an approach when you're near this loss. Or walk through the motions, run through some of your examples of the 5 or 6 other ideas that we reviewed to see if something matches your goals or helps you get back to break even better in that case.